Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're once again joined by Tim Weston, who is a property investor and a property partner here at Opes Partners. And today on the show, we're talking about the other side of Tim's investment portfolio. On yesterday's episode, we talked about some of his recent renovation projects, but now we're going to change gears slightly and talk about some of the new properties, the brand new properties he's recently added to his portfolio. Now, it is quite interesting, Tim, that you've got this mix of both the renovation side and the new properties, because some people tend to pick one or the other. What's kind of the reasoning behind of taking this kind of mixed approach?
Good question.
He just likes to take every possible good deal that comes across our desk.
Yeah, absolutely. Anything that's a good deal. But I guess I have been for the last, say, 15, 20 years, always it's been sort of renos and so on, but I had the time to do it, when now it is somewhat, time is just so valuable, especially with a young family and so busy with work. So, and it's just the extra stress, anxiety that you just don't need. So going new is sort of, now we've turned that page. The properties next door were somewhat just a good opportunity. We run a B&B from home, and we thought we'd use them as an overflow or Airbnb and so on, because we had a short-term property management company. So it just fit what we were doing, to be honest. We picked up a couple of places on Salisbury Street, which was a development that we had through Opes that was great. So we ended up buying 2 places in there.
Coastal Apartments. Ed actually owns one of those as well.
Ed as well. Yes. There's I think 5 of them were picked up through staff actually.
Yeah,
and what was the rationale behind? Because those weren't new; those were existing, but had been recently renovated. So what was the rationale behind those ones?
Yeah. So they were 2-bed, 1 bathroom with a car park. So the first thing was really the price point. They were $399 with a $15,000 cashback. Obviously, cashback isn't something that we see all the time, but it was just the developer needed them gone. So a net $385, and bringing in like $400 a week, they were great. They were fully renovated, so right down to new heat pumps and new hot water cylinders. So my rationale behind that was where could you buy within the 4 Avs and really a good part of the city.
So this is central Christchurch for any listeners outside of Christchurch?
Yeah, literally 50 metres from Colombo Street, and from that Colombo Street on Salisbury on the other side is more the blue chip part of Christchurch. So I'm sort of 50 metres from really the most blue chip part of the CBD. And I thought, how often, or as far as an opportunity, could I pick up an apartment, 65, 68 squares, that sort of thing, fully renovated, so I don't need to do anything to it, for $385,000.
They were a great deal.
For, in 5 or 6 years' time, they'll be worth $500. It's great. It was cheap shopping.
And actually, Tim, you rented out one in a traditional mechanism, and then the other you Airbnb. Do you still Airbnb it?
Well, no, we're not. We had a really good run with it being Airbnb, and then and we had our other unit was long term. We fitted it all out, and look, it was $10,000 to fit out with furniture and so on that you need to as a Airbnb. However, when sort of COVID came through, I guess we didn't somewhat panic, but we just thought,
you wanted the certainty.
Yeah, what we were going through, and we just didn't need that. You're always looking at the calendar and making sure that the guests are coming and so forth. So we just felt that extra pressure that we didn't really need. So we just put it long term. So it's fully furnished, so we'd get an extra $30 a week for all that sort of thing. And as soon as we put it on the market, it was rented.
Okay. And that's some pretty impressive gross yields anyway, buying straight off. 385, 384 is what you paid for it. Getting that 400, that's a 5.4% gross yield. Even though we often say don't look at gross yields, but it's a useful point to just get a sense of it. But really high yielding,
absolutely,
in the sense. And what about some of the other newer properties that you've invested in recently? What have you invested in? What have you paid? And what has made you invest in that specific one versus something else?
Okay. So with what's really going on with like population growth and throughout the country, we know Hobsonville, Auckland has been rated number 1, and Christchurch CBD has been rated number 2. So looking in the city was definitely where we wanted to be, and where we are looking. Now there is another development on Salisbury Street, 100 metres away or 200 metres away, and on the right side of Colombo Street, so to speak, and that's called Soho. So it's
still under construction. We're about 3 months away from completion,
correct.
I think. Yeah. So you bought this one before Koto, but obviously Koto was finished.
Correct.
And so now Soho is several months away from being complete.
Yes.
And so you bought one of the penthouses from memory.
There's there's 2 blocks of apartments, and then there's 6 townhouses actually at the back. So we ended up getting one of them.
The townhouses.
Correct, yeah. And they're like 2 bedroom, 2 bathroom with a car park right out the front. They're 2-story, they're about 72 squares, that sort of thing.
Good size.
And they were around that sort of 550 or 570 price.
I think they're 560, 500.
Yeah, that's it. And the developer had a $23,000 cashback at the time, obviously for finance and so on, or for the bank.
So often, for listeners that haven't heard of these before, and they aren't common, but we do get them. A developer of a large development will often give a cashback incentive rather than discounting the price. A cashback incentive for the first, say, 50% of the pre-sales, because that's what it takes to get them over the funding line with the banks. So they might give an incentive at that, and then after the 51st unit, they'll charge the full fee.
That's right. Yeah. So that was a good opportunity, and literally we're paying somewhat market rate, but 23 grand back. It's kind of
what was that total?
So it was like, say, 560,000.
Minus 23.
Then we settle on that, and then on the day of settlement, we received back $23,000, which is
so
great.
that one's just going to be a normal rental for you, Tim?
It will be. Yep. We did look at, again, short-terming, but no, it's just long-term.
I think from memory, yields were lower on that, but you've got a brand new property. So
brand new
less
property, don't have to do anything.
Yep.
And look, if rates are so low, the expectation was around that sort of 520, 540 a week. Even if we get 500 with rates being low, it'll still pay for itself, which is great. Yeah. And again, being in the city, but it is 2 bed, 2 bath. But comparison with the ones down at, say, Koto, there's almost $185,000 difference, and even though one's brand new and has got an extra bathroom, that's really the only difference between them. And it's a big difference, 180 grand.
And so, Tim, as well, just walk us through, what is your plan for this, for say, that one, the Soho there? What's your long-term plan for that investment?
Yep. So, look, just buy and hold. We'll just use that as a long-term. Same with the Koto, and then with the 3 that we've got, the 3 2-bedroom units that we have in next to us in Riccarton.
And then you've also got Peterborough under contract.
And then, Peterborough as well. So that, again, that was really one out of the bag that we really, really liked. Great little catchment there.
This was another sort of inner city development.
Yes.
Again, within the 4 Avs. That project sold down in a day.
Hours.
Yeah. It was insane. Yep. 8 units sold in a day because they were priced well and they were an amazing value proposition.
Good spec.
Bit more expensive, but higher spec.
Yes.
So some of your properties are at that higher spec. So I noticed the transition of your portfolio has kind of gone like mine. You've started out with the hard stuff where you renovate, get your hands dirty, and try and recycle deposit as quickly as possible. And now you've sort of transitioned to the more premium grade that you don't have to put as much money into, and they'll be better for holding long term, right?
Absolutely. Yep. We'll get more out of them.
So, Tim, let me ask you this: how do you know that there was a good price? And for people listening to this show at home, what are some things that they could do to replicate that? Because obviously it's a bit different because you're in the market every day, right?
Yes. It was more, look, we see a lot of stock that comes through, and I actually think I go home to my wife most nights with new stock and say, gosh, we should get this and that.
Gets told no.
So I like literally everything that comes through. But the cashback was good, but it was more, I like the area, I like the design. I was looking around at that sort of price point, and it just fit. So it worked with our model. But now that we've got a good selection in the city, and going back actually to Peterborough Street, that was a 2-bed, 2-bath with a garage. So finding something with a garage in the city, and they were $599. It was great. So they'll obviously just rent really well.
And you're focused primarily on Christchurch, right? And so what's been because I understand you live here, but what was the thinking behind investing quite heavily in Christchurch in this instance?
It's more, and I know with all the data that we have on our website and everything that you do ahead is that Christchurch is so undervalued at the moment, and we're like 15% below our median. So and the expectation, and this was pre-COVID, a number of like bank economists were coming out and saying that there should be a 6.5 to 7%.
They just listen
growth.
to Ed.
Yeah. Growth over the next sort of 3 to 4 years, and that's when like some of these, the motorways are finished, like the metro, they've broken ground, the new sports facility, the town hall, obviously they're finished now,
Stadium, the convention centre,
stadium, and so on. So that once that happens, there's going to be some good uplift. So I just thought, from looking around and for prices that I know places were selling for, it was good value for money. Yeah.
I do think that in 5 years' time, everybody will look back, see that Christchurch house prices have increased, and everybody will be a genius saying, "Oh, look, of course, house prices in Christchurch were going to increase because they were cheaper than Dunedin and they were so heavily undervalued." And everybody will look back and go, "Oh, of course that was going to happen." But looking forward, you don't need. It's quite.
No, it's tough.
It feels like you're taking a bit of a punt.
Well, you are, because that's when the market is flat, and so it's only in retrospect that people are experts. They don't have podcasts that they can go listen to episode 11 where we said it was going to happen.
Exactly. And it's not, every city's got a new $35 billion city. So there's a lot of good opportunity here. But going forward, look, I'll be like more of a freestanding house and land sort of property, like, Rolleston or Lincoln, for example. So I'm looking at probably getting 2 more in sort of Christchurch or greater. And then I will be next year probably 2 more, and it'll be like probably Hamilton and Auckland.
Awesome. I think that's a great model to follow.
And Tim, last question. A lot of people listening to the show at all different stages of their property investment journey. And so they'll be really interested to know, where do you get that initial equity to be able to go and buy, we're talking about, 6 odd new properties in a relatively short period of time. But what a lot of people won't know is that you've worked very hard for 20 years. Do you want to just give a preview of that to show how you got the equity?
Yes. Well, I left school at 15, so
school dropout.
That's 26 years ago. So I have been working for quite a long time. I bought my first house when I came back. I lived overseas in Sydney in the UK for 4.5, 5 years. So when I was 25, I bought my first place and then started working. So I've owned a number of businesses and sold. Most of them are profitable, and sold them all, which was good. Did a large renovation that took 2.5, 3 years to do. So I ended up having to sell 6 of my companies that I had to sort of fund that renovation. It blew out by like 7 figures, so it was quite a strange sort of situation to be in.
You can watch that on Grand Designs.
You can, yes. So I guess now I've done what I've been financial planning for about 15 years. I've really done what I tell all my clients not to do, because really it's great to have a nice house and have a roof over your head, but to have so much money and capital tied up in a property, it's really one out of the bag. Like if it was just a beautiful house on the hill, probably wouldn't have done it. But as my wife's father was somewhat well known, and the home somewhat has got some beautiful character about it, and it's quite a heritage sort of spot. We were kind of not forced, but we're in a position that we felt that we should have.
There was emotional attachment.
Absolutely, yeah.
And there are some amazing podcasts that Tim and I recorded probably about 6 months ago that I'll link to in the show notes, because Tim went through a lot of the details and some of the heartbreak that happened throughout that renovation. And there were some really amazing episodes actually. So I'll link to that in the show notes. And I think that what's quite important to remember as well, as Tim's talking about buying 6 to 10 new properties in a very short period, is that there's 25 years of hard work building up the equity in order to be able to do that.
Yeah, absolutely. Yeah. Because like property was so much cheaper then. I bought my first place for $200,000, when now it's probably worth $450. I wish I kept it, but when you're young, you sell them, you make some money, move on to the next. But now with the Bright Line test, you've got to pay tax and GST, and there's agents fees. So buying and holding, new, just long-term strategy, it's just a perfect picture.
Fantastic. Well, let's wrap it up there. But please don't forget to rate, review, and subscribe to the show. It really does help us get the message out to more people. And hey, if you want to learn more about property with Andrew and I, why not check out our No Money Worries email course? This is where we've collated our top 9 lessons about property investment, and we've even included some homework so you can test what you've learnt and also just think through a little more deeply about how you've invested in property in the past. Now, I'm going to link to that in the show notes, so tap or swipe over that cover art, click the link in there, or you can also just go to opespartners.co.nz/no money worries. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics and insights to help you get the most out of the New Zealand property market. Until next time.